Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we continued our course on the basics of futures trading with a look at the primary purpose of the futures markets, which is to hedge price risk. In today's lesson we're going to continue this discussion with a look at how this process is standardized through the futures exchange and the futures contract. So let's get started.
From the example in our last lesson, we should now be able to see some of the great benefits that hedging offers both consumers and producers of different products. Now that we have this understanding, however, we should also be able to see some of the disadvantage of hedging price risk on a private one-on-one basis. These are primarily, number one, settlement risk. When this type of deal is done on a private basis, as in our last example, neither of the parties to the transaction have any guarantees that the other party is going to make good on their end of the deal. This can especially be a problem if, as in our last example of agreeing to trade corn for $4.75 a bushel ahead of time, the price ends up being a great deal different from $4.75 when it comes time to deliver. Number two is no central marketplace. A second issue that arises is a lack of price transparency for both the buyer and the seller in terms of knowing what price other similar deals are being done at, so they can both make sure they are getting a fair price. If there was one central place where these types of deals were all taking place, they would both not only be more comfortable that they were getting or receiving a fair price, but also would have other people to transact with. This is something which is known as liquidity, which we will discuss further in later lessons. Number three is a lack of standardization. While the fact that the deal done in our last example was completely customized to the needs of the two participants can be seen as an advantage, it is also a disadvantage from the standpoint of the lack of efficiency involved in having to match two people up who have exactly the same wants and needs. Secondly to this, as we discussed in our first lesson, if either participant wishes to back out of the deal before delivery time, then they would need to find someone with the exact same terms to offer to step into their place. Now that we understand this, we can more easily see how standardizing and having one central place where these types of transactions take place offers a much better solution for all involved. Let's look at how the futures contracts and the futures exchange accomplish this. From a settlement risk standpoint, one of the most important roles of the futures exchange is to eliminate settlement risk, or the risk that one of the parties involved in a transaction does not deliver on their end of the agreement. They do this through what is known as a clearinghouse, which is ultimately the counterparty to all trades. What this means is that when I buy a futures contract from another person who sells that futures contract to me, we are technically not trading with each other, but with the clearinghouse. This makes trading in the futures market much more efficient from the standpoint of settlement risk, because instead of having to worry about who the person is that I am trading with each time I place a trade, I only need to worry about the clearinghouse, which is generally a AAA rated financial institution. It is the role of the clearinghouse to make sure that all trades are made good on, which is one of the reasons why traders are required to have a certain amount of cash in their accounts for each trade that they place, something which we will discuss further in later lessons. Number two is the futures exchange provides a central marketplace. By having one place, the exchange, where all deals take place, this not only allows everyone to see the price where similar deals are transacted, but also brings an extra level of competition into the mix. Because of the centralized nature of the exchange, there are generally multiple people willing to buy and sell at any given time, which drives down costs and makes the market much more efficient than it otherwise would be. Number 3 is standardization. Like the forward agreements that we've discussed in previous lessons, the futures contract is basically an agreement to buy or sell a particular commodity or financial instrument, for a specific price at a predetermined date in the future. What is unique about a futures contract, however, is that with the futures contract, everything, with the exception of price, is completely and 100% standardized. Each futures contract specifies a specific amount, quality, delivery date, and delivery place for the commodity or financial instrument that you are trading. The fact that the futures contract is standardized simplifies and makes the process of hedging and speculating in the futures markets much more efficient. Through the futures markets, hedgers no longer have to find someone with the exact opposite needs of themselves to transact with, but instead can trade one or more standardized futures contracts based on their needs. In addition to making the process of hedging much more efficient, this process of standardization also makes speculating in the futures markets more straightforward, because the speculator only has to analyze the futures contract they wish to trade and not each individual deal, as they would have to if things were not standardized. Bringing together people to transact on a central futures exchange with standardized futures contracts was so popular for agricultural products, it has now been expanded to many other markets, including financial instruments such as interest rates and stock indexes, precious metals, and energy. And this is a topic we will begin to explore in coming lessons. That's our lesson for today. As always, if there's any questions or comments, please feel free to leave them in the comment section below. And good luck with your trading.